Good evening. Welcome to the Redefine half-year results presentation for the 2013 year. As usual, I'll be doing an overview and strategy review. David will take you through the property portfolio and Andrew will take you through the financial results. Our strategy, as usual and as it always has been, is that Redefine is committed to being the property owner of choice. It's not necessarily to be the biggest player, but the best. The company's primary objective is to provide sustained and growing income for investors. Underscoring this is our pursuit of revenue-enhancing opportunities so that we can sustain increases in distributions and secure the prospect of long-term capital appreciation. Our investment proposition is we have attractive real yields, the prospects of capital appreciation, high visibility of earnings, a diversified property portfolio, improved quality of the property portfolio, very limited speculative development, geographically diversified. There's an element of rand hedge through our investment in RIN. We've got a proven management team and we are no longer reliant on fee and trading income. The graph on the right shows you that 74.5% of our property asset base is South African property, 18.2% is listed, and international accounts for 7.3%. This is just to understand our strategy, and I'm not going to go into detail. It's self-explanatory, and you can have a look at it, but we embarked on this strategy 18 months ago, and it's how we are going to deliver and are delivering sustained value to our investors. Our investment philosophy, we start with the bottom-down process. Our deal turnaround times are short. It starts in my office and works its way down through the various divisions, not the other way around. Our investment criteria, first we look at tenants, the period of the leases, consistent renewals, the property location. It's got to be key to attracting our ideal tenant profile and where we want to be. Property size, we don't look at properties unless there are exceptional circumstances of under 70 million, which offer management economies of scale. As we said previously, focus is on prime areas, high growth nodes, what we term hotspots, and pricing is obviously dictated by the market. At the moment, there's a strong demand for prime assets and it's not easy to come by, and pricing is tight, driven by low interest rates and the availability of cheap funding. All properties are considered on their merits, and we're obviously giving preference to retail so we can change our mix. Our offers are positioned to be compelling, so we always look to see, is there something we can add that makes a good deal better, or something that we can do which will cause the seller to choose us over a competing bidder. So just by way of example, and to deal very briefly with our last major acquisition, which was East Rand Mall. The process was quite simple. What happened was that Sanlam advised certain players in the market that they wished to dispose of it. Vukile had a preemptive right, and they sent out to those people who were interested a pack detailing income, expenditure, and a number of other items which related to the centre. So the first thing we did, we thought we'd be clever, and we went to Vukile and said, will you sell us your preemptive right? They weren't interested in that, but it was a good try. It also told us that, having not wanted to sell their preemptive right, that they were going to want to remain in, and we then offered, if we were successful, to partner them. Based on the net income projections that we were given, and having walked through them all, looked at trading densities and opportunities, we believe that the property was in truth of fact worth about 7.25% forward yield, which would have amounted to about 2,125,000. But we also knew it was going to be a highly competitive bid, and if we wanted it, we would have to pay a little more. So we went in at 7%, 2.2 million, 75 million more than we thought it was actually worth. But when we looked at this, we said, okay, well, that adds 1 year to the payback period. And in terms of our funding costs, it cost us about 5 million a year in income. As it happened, we were correct because there were 2 bids which were identical and a number of bids around the 7.25% yield. So with 2 bids identical, why was ours successful? Quite simply was one of the things we did was make it as clean as possible. We put our bidding together with a board resolution. We had the approval required, and that was the only approval we required. And we had a letter from our banker stating that the funds were available. So our only condition was Competition Commission, whereas we understand the competing bid had a number of other conditions. Insofar as the building itself is concerned, yes, there were a number of items that needed attention. This came out in our due diligence and were attended to by the seller. Whilst we also understood that the building needs some money spent on it, we didn't think this was material, and this will be taken care of as and when we expand and use the 11,500 square meters of bulk that's available. We've looked carefully at all of the trading densities, which tenants need expansion, who's not there, and over the next 12 months and 18 months as leases expire, we'll be implementing some value add to the East Rand Mall, and very, very happy with that purchase. So that just gives you some idea of the way we go about things, a very brief one, but we certainly just don't run around and decide on a price. It's carefully considered, it's debated at length at our exco, and then taken to our investment committee and ultimately to the board. As I said, about 18 months ago, we changed our strategy. We told you what that strategy was. We very much kept to it. So where are we 18 months later? First of all, our investment proposition has been substantially improved. The average value of our properties is now 83 million. It was 54. Our single tenanted properties by value have increased to 31% of the portfolio. Our percentage of A-grade properties by GLA has increased from 50% to 65%. The percentage of properties outside the Cape, Gauteng and KwaZulu-Natal has decreased from 14% to 7%, and these are largely retail, which we'll keep. Our renewal success rate has lifted to 82%. Our core property margins have increased from 73.2 to 76.7, and we think there's still some more room. Our average cost of funding has decreased from 9.6 to 8.6, and that will come down further next year. Our reliance on lumpy, non-recurring income has been totally eliminated, as you'll see from these results, and the restructure is ongoing without suffering much dilution in earnings on the revised base. So we started off 2011, we had about 450 properties. We're almost down to half. The first big chunk went to Arrowhead, and I think that's proved to be more successful than anybody, including us, ever thought. So that was the real impetus, and we've continued on that base. It is part and parcel of our function, and although we are largely complete with the sales process, we're always going to be selling something because it's our job to recycle capital. So when we find a building that's mature or is not giving us the required growth, we have a look and see what we can do with that and recycle it if we sell it and reinvest the money in a better quality property, which will over a period of time give you much better returns, both in terms of income and capital appreciation. So that's where we are. The only change to the strategy, we've stuck to the original plan. Fountainhead, the acquisition of the property portfolio, would have largely completed the metamorphosis of our portfolio. As you know, we've now had to withdraw our offer for the assets and own 46% of the funds. So essentially, we have switched about 60% of our Hyprop holding into Fountainhead units. That situation will remain for a while, and then we'll revisit. But in the meantime, we're quite happy with that, because if you go back in time when we got involved in Hyprop, it was about a 6.50 Rand or 7 Rand share price. Today it's touching 80 Rand. We think that that's now mature, and we did think that. We think there's a lot of opportunity within the Fountainhead portfolio, and we'll seek to be looking to add value to that portfolio for our benefit and for the remaining shareholders, and then we will decide over a period of time whether we will revisit the offer for assets. There's a shortage of well-priced assets, so that meet our investment criteria. So that necessitates the need to develop or partner developers to create new investment opportunities. We've now got to the stage where we can actually develop really good quality properties if they're tenant driven at yields in excess of what we can buy these properties in the market. So that's something which we will pursue, and that's a small change to the strategy. Priorities for the rest of 2013 and going into 2014 is to reduce the high exposure to government tenanted offices. This was part of our original strategy. We are very far down the line in achieving this and hope to sign an agreement in this regard in the next week or two, and that will complete that one. Simplifying the RIN holding. As you know, we are looking at an inward listing. It's all been going reasonably well. There's now a hiccup at the Reserve Bank side, but we hope to get that sorted out shortly, and hopefully prior to year end that will be resolved. We will continue to pursue pre-let tenant demand driven development opportunities. I think you all know that we were awarded the Weber Wenzel tender for Sandton. We've already started demolishing, and it's that kind of opportunity that we look at. We've also just completed a distribution warehouse for the JD Group and are completing one in Cape Town for More Sport, and we continue. When we took over Apex, we inherited an electricity contract. We're now internalising that, and we think that will improve our electricity recoveries. We've also got to bed down the Fountainhead property management. As I said earlier, I think there's a lot of opportunities in that. Focus on reducing our cost of debt even further, and if possible, deepen our presence in Australia. Cromwell has been a fantastic investment for us. They look at some really nice opportunities, and if we can get Reserve Bank approval, we would like to partner them in some of the opportunities directly, as opposed to increasing our shareholding, which in terms of Australian law becomes quite difficult if we go over 30%. With that, I'll hand you over to David, and I'll be back a little later to talk about prospects. Thank you.
I'm going to talk to you about the property portfolio as at the end of February. I'm also going to compare that to what we see the shape of the portfolio being in the not too distant future. To start off with, the largest investments at February are offices, and approximately 30% of those offices are government tenanted. The GLA generally is spread evenly across the sectors with a portfolio of 244 properties. The 73 single tenanted office and industrial properties, which occupy 30% of the total GLA and 31% of the portfolio by value, and 61 properties, each greater than 100 million in value, which occupy 48% of the portfolio and total 61% of the portfolio value. In the future, as is probably known, we've acquired Nickel Way Complex, commonly known as Design Quarter, and the East Rand Mall. We're involved in developments at 90 Grayston Drive in Sandton, 90 Rivonia Drive for Weber Wenzel, and the Matlasana Shopping Centre in what was previously known as Clarksdorp. Now in total, that's 4.5 billion rands worth of property. We're at documentation stage in selling the government portfolio, which is approximately 2.5 billion in value. And it's all in line with our strategy of acquiring and developing good quality properties in prime locations and disposing of the government tenanted portfolios. The net result is a reduction of 21 properties, with the portfolio value increasing to 23.7 billion, and a significant improvement in the quality of the portfolio. It'll give us increased exposure to regional shopping centres. 64 single tenanted office and industrial properties now occupy 31% of the portfolio GLA and 33% of the portfolio by value. 57 properties, each with a value greater than 100 million, occupy 50% of the portfolio and 67% of the portfolio value. So 160 properties essentially make up the remaining third of the portfolio by value. By geographical spread, as would be expected, 64% of the investment value is in Gauteng, likewise with GLA and the property count, and that's a value of just under 14 billion. The future portfolio, the largest investment will now be in retail and not offices. The total number of properties will be reduced from 244 to 222, and the Gauteng investment increases from 13.8 to 15.3 billion, notwithstanding the reduction in properties. The average property value per sector, for the first time, both offices and retail properties have a value in excess of 100 million rand. And that again is an indication of the successful implementation of the strategy. Acquisitions and disposals, there's been very little activity during the 6 months. We've acquired one property and disposed of a number of properties, each with a value of 60 million rand or less. The East Rand Mall was acquired and transferred after the 4th of April, and Nickel Grove is expected to be transferred later during the financial year. We also acquired land in Cornubia, which is north of Mount Edgecombe in Natal, which will be utilised for development purposes. It was approximately 15,000 hectares, and it's expected to transfer in about October of this year. Tenant grading, the A-grade tenants contribute 70% of office income, 60% of retail income, and 60% of industrial income, and they occupy 65% of the total GLA. Interestingly, the government, banks, and national retailers contribute greater than 50% of the portfolio income and occupy greater than 50% of the gross lettable area. Leasing activity for the 6 months, the vacancy percentage increased from 5.6%, approximately 170,000 square meters, to 6.9%, approximately 214,000 square meters, which is approximately 40,000 square meters of vacant space. The major vacates were at the Premier Milling Building in Waterloo, 27,000 square meters, and the Amalgamated Appliance property in Boysons, south of Johannesburg, of 10,000 square meters. Leases covering gross lettable area of 528,000 square meters expired during the 6-month period, and tenant lease renewal retention was 82%, being 91% for retail, 88 offices, and industrial 63, essentially as a result of the 2 large vacates. Excluding those would have been approximately 80%. The lease expiry profile is now much improved, with expiries for 2014 and 15 less than the number of less than the amount of leases that have been renewed for the 6 months of this year. At the beginning of this year, we had approximately 800,000 square meters of space to be renewed, and that's now evened out over the forthcoming period. You'll see that in previous years, 2011 and 2012 also had significantly higher GLA to be renewed. The letting activity for the 6 months, well, we're happy that the renewal growth for the portfolio has been 7.2%, and significant growth has been achieved with retail at 9.3%. What's also, we're also happy with the fact that the average lease escalation for renewals has been approximately 8%, and for new leases 8.7%. The rand value of leases concluded, both with renewals and new lets, totals in excess of 1 billion rand. Okay, there's approximately 3 billion rands worth of development underway at the moment. The major ones being the 2 developments in Sandton, Matlosana, and the Standard Bank property in Cape Town. Individually, the 90 Grayston Drive property, which we commenced at the end of last year, expected completion date is July 2014, and you'll see in the bottom right-hand corner is a picture essentially of the property. It's going to be about 19,000 square meters. We don't expect letting activity to take place much before the last quarter of this year. 90 Rivonia Road is being developed for Weber Wenzels. It's approximately 35,000 square meters, just under 1 billion rand in development. Initially, they will occupy 26,000, with 9,000 being sublet and will be taken up by them in due course. 190 Barbary Road is a factory in warehousing in Barbary Road in Sando, approximately 95 million rand in value, 14,000 square meter facility. Where essentially we started building that on spec. There are a number of potential parties on the table, and we're comfortable we'll let that space prior to completion. Matlasana in Klerksdorp, a development that we acquired, approximately R1 billion, 63,000 square meter property, local regional centre, and completion date due at the end of 2014. Then Standard Bank building in Cape Town. Intention is to develop a block of parking which will increase the parking ratio significantly. The initial return of 6.4% will be increased significantly once the letting of the vacant space has been taken up at a far higher rental due to the parking facility. And then property management. We're asked from time to time how we manage a portfolio of this size. I thought I'd give you an overview of an organogram and how we go about this. Initially, there are national or regional heads of the portfolio. National for commercial, industrial, and retail, and regional heads in the two major provinces. There's a retail analyst in place whose function is to analyze the results and well-being of all the South African retailers and overseas retailers where we believe that potentially a brand will be coming into the country. There are leasing divisions by sector, both retail, commercial and industrial. There are property and shopping centre managers responsible for the day-to-day activities of individual properties. They're supported by accounting and support and administrative support, probably 40 to 50 people around the country attending to that function. There's a facilities management team. Again, it's regionalised, and major aspects such as air conditioning and lift management are outsourced. There's a tenant relationship management team who essentially focus on the large tenants so that we're not reactive to tenant requirements. And there's a call centre which takes all calls relating to administration, maintenance in properties, etc., etc. There's a development management team, and you've seen the extent of the development underway. And then we have an internal legal department. Insofar as Fountainhead is concerned, the majority of the management is outsourced. 7 properties are directly managed by Redefine. The executive and asset management takes place through the Manco, and there are full support of the various Redefine divisions overseeing the outsourcees. Thank you very much.
Okay, just looking at the financial results for the half year ended 28 February 2013, some highlights. You'll see that the half year distribution is 33.7 cents. That's growth of 7% on last year, and it's at the upper end of our market guidance that we provided at the end of last year. The accounting treatment of Redefine International has been simplified. We've now deconsolidated Redefine International, and it's now accounted for as an equity associate, which means that our balance sheet is hugely simplified and our credit metrics have been enhanced. I'll go into a lot more detail shortly on that. Our tangible assets, as you can see, have grown to 31 billion rand, and our net asset value, mainly due to the deconsolidation of Redefine International, has improved. It's grown from 8 rand to 8.31 rand in this period. Our market cap is on 30 billion rand, and that is before the additional units that we intend to issue towards the end of this week that have arisen from the accelerated book build that we conducted last week, whereby we raised 800 million rand. The presence in the debt capital market continues, and we have recently issued a further 1.5 billion rand at very favourable terms, further strengthening our position in the debt capital markets, and we intend to go there for some more funding in due course. Our local contribution is up 9%. We're very pleased with that. A lot of that growth has come from restructure benefits that began during the course of 2011 through 2012, and now we're starting to see those acquisitions coming through quite nicely. And once again, I'll take you through a slide which deals all with that growth story. Looking at core property margins, we are pleased to note that they've grown by 1% on our core business, and that's come through cost containment, which once again I'll explain in a lot more detail. Our average cost of local funding has grown by 30 basis points, or it's reduced rather to by 30 basis points to 8.6%. And there will be more savings to come as a result of the further presence in the debt capital market in the second half of this year. Moving then just onto our corporate structure. 2013 first half has been quite uneventful. However, there have been two significant events on our corporate structure. The one being Redefined International has reduced down to an effective holding of 32.5%. It was around 39% last year. And Redefined International Fund Managers, we increased our investment there to 90%, which is an increase of about 14% on last year's shareholding. And then just to add, post the reporting period, we have increased our holding in Cromwell by a further 6%. And in terms of Hyprop and Fountainhead, we've reduced Hyprop to about 11.4%, and Fountainhead has grown to 45.6%, mainly through a switch of those two units. And there's been some cash as well as redefined units issued as well to fund that extra investment in Fountainhead. Looking then just at the distribution for the first half of 2013, stripping out non-recurring fee income from the prior year and also the dilutionary effects of the additional units in issue that arose from last year's shares that were issued, you'll see that growth of 9.3% in distribution terms was achieved. And then if we look at the full distribution of 33.7 cents, you'll see it's grown by 7% on 2012. Just looking at contributors to distribution per linked unit, you'll see that the biggest contributor to the distribution comes from our core property portfolio, where approximately 80% of our income is derived from our core property portfolio. Once again, we are pleased to note that there's no reliance now on non-recurring and lumpy fee income, and the local operations have generated 90% of the total distribution. Just looking at drivers of the growth in distributable income, this slide takes you from the actual result last year of 846 million, and we build it up to the 930 million rand that we distributing in this period. You'll see that 96 million of the growth comes from the core property portfolio, and you'll see that about half of it, almost about 49% of that 96 million comes from the new properties that we've acquired. Listed securities has declined slightly, mainly due to the sale of some Hyprop units, the disposal of Oryx last year. And then just to note that the associates have declined by 5 million rand. That is mainly due to the moving of Cromwell to the listed security line because of the change in holding in Redefined International. Fee income, it's at 44 million rand and growing. The main reason for that is because of the Fountainhead Manco that we've acquired. About 2/3 of that number is purely Manco income, and it's recurring income. And you'll see that Redefined International has grown about 15 million rand. That's mainly due to the benefits of the capital raise last year, as well as the rand weakening against the pound. Just to go back to finance charges, have grown by 53 million. That's purely driven from additional funding. Our debt increased by 1 billion rand since last year. Looking then just at the distributable income, broken up into its components. I've already covered the percentage changes, and this just provides the full numbers for one to compare to last year, so I won't dwell on the slide. Looking then just at the core property portfolio. Now, core properties are those properties that we've held for 6 months in this period and in 6 months last year. So they're in for full periods on both sides. You'll see that the income has only grown by 4.8%. I'll explain in detail why it has grown by such a percentage. And as you can see, the 6.3% growth on the core property portfolio line has arisen as a result of the core property costs being held to last year's levels, which I will once again explain in due course. The balance of the growth, as you can see, comes from newly acquired properties in 2012, which are in for a full period during 2013, giving the balance of the growth to 10.3%. Also pleasing to note, as you can see at the bottom, is the core property margin, growing by just over 1%. Looking then at core property revenue, you'll see the 4.8% growth is driven by letting activity. If you cast your eye to the new lets, a total column, you'll see that we gained 19 million rand in revenue from new lets. That translates into growth of 1.9%. However, offsetting that is revenue lost from vacancies of 29 million rand, which is a negative 2.8% growth. So if you combine the two lines, you'll see that we went backwards by about 1% as a result of vacancies exceeding new lets, and that has arisen mainly in the office and in the industrial portfolio. You'll see that the retail portfolio has done very well this period. It has grown on 2012 by 6.7%, and its new lets and its vacancies have offset one another quite nicely, which has enabled that to come through. Offices, as you can see, are battling. Vacancies are 9 million rand versus new lets of 3. And similarly, industrials suffered a loss of 13 million rand versus 9 million on new lets. Looking then at core property costs, as you can see, we've worked very hard here to keep our costs growing at 0% overall, and there are swings and roundabouts on all fronts. As you can see, net municipal charges, there's been a big pullback there. There's been a number of accruals that we've been able to release that are no longer required. We've also been able to restructure new leases, and also as a result of the new acquisitions and a move to single-tenanted properties, we are able to improve on both the recoveries for municipal charges as well as electrical charges. Looking forward on electrical charges, that is a line that's going to move into positive territory as a result of the acquisition of the rural recovery of electricity business. Operating costs have grown somewhat, but that's due to a reallocation of costs from admin, which you don't see on the slide, that have been now allocated to this line. Property management is well controlled at growing at 2%. Repairs and maintenance, although down just under 9%, that's a timing issue. And in the second half, there'll be some catch up on that cost line. Tenant installation costs and letting commission, those are costs that are deal driven. Management fees have grown 14%, and that's mainly due to the outsource of facilities management in the coastal areas. And then you'll see a decline of 11% on bad debts, mainly due to last year having a higher than usual level of bad debt write-offs. Looking then just at our cost metrics, you'll see that on every count there, whichever one you choose, you'll see we're moving in the right direction, going back to 2010, which was our base year before we internalized property management. We're very pleased with all those percentages. They're moving in the right direction. Just looking at our margin or the efficiency of our trading, for every 100 rand, how much converts into property income. If we go back to 2010, you'll see it was 75 rand or 75%, and that's grown to just over 76.5%. So over the 3-year odd period, you'll see we've improved our margin by about 1.5%, and that's principally arisen from the second line from the bottom. It's on management fees. You'll see in 2010 it was 4.5% of revenue. It's now just under 1%, and that's due to the internalization of property management in the main. If you cost that number out, that's a cost saving over the period of 40 million rand in perpetuity that we achieve as a result of that internalization. Looking at our balance sheet, as I said earlier, it's hugely simplified. We've now removed Redefine International from our balance sheet, and it's now accounted for in the associates line. I'll deal a bit more on the debt side, which as you can see compares very well now to our asset base. Our loan to value is now about 34%, and our NAV, which I'll talk about shortly, has been hugely improved as a result of stripping out debt and assets of almost an equivalent amount. Looking at our net asset value, going back to 2012, February, you'll see that we've grown it by about 10.5% to just on 8.30 over the period. And you'll see in the current period versus last year, we grew about 30 cents, and 2/3 of that came from the deconsolidation of Redefine International. Looking at our funding, you'll see that at the end of the first half, we had just over 10 billion rand of debt. It is about a billion rand greater than last year. And as you can see, there's a small component offshore that's in respect of Redefine International fund managers, with the bulk being onshore, being 10 billion rand, with 800 odd million thereof from the debt capital market. Our intention is to increase that to about 30% of our total debt. And as I said earlier, subsequent to the half year, we did raise some bonds totaling 1.5 billion rand subsequent to February. Looking then just at loan to value, as you can see, slightly under 35%, which is just in line with our target. Our percentage of assets secured has dropped from 74% to 66%. Our weighted average cost of borrowings have similarly declined, and our percentage of debt that's been fixed is being maintained within our management target, sitting at 66%. Our average length of fixes is just on 4 years. And I'm pleased to draw your attention to the fact that Moody's credit rating has remained unchanged during this period. And I just want to draw your attention to the fact that subsequent to the half year, as I said earlier, we did raise 1.5 billion from the debt capital market, but in addition to that, a further bank debt of 1.1 billion rand was raised, and we also undertook an accelerated book build whereby we raised 800 million rand last week, taking the total funds that have been raised since the half year to about 3.4 billion rand. Looking at our abridged cash flow, the main line to focus on would be our local achievement, which is the first column, and you'll see that we've been very careful in managing our cash, whereby every surplus rand that we generate, we apply that to debt, so that on our revolving credit facilities, so that we don't have any unproductive cash on hand, and that is used to partially fund investments. So as you can see over the period, we comfortably covered through our cash generated by operations, our interest burden, as well as our linked unit holders distribution, leaving us with a cash surplus of just under 140 million rand. And then we had investments of just on 1 billion, and we raised funding during the period of 900 million, giving us closing cash of 17 million rand. Now that 17 million looks low, but within that 17 are revolving credit facilities sitting in the funding line above, which we can draw upon to meet immediate cash needs. Unit holder profile, as you can see, our top 10 unit holders comprise just under 42% of our shareholding in total. And it's interesting to note that State Street, I've highlighted it in green, is the only international investor in the top 10, but now holds 5%. So it's jumped up into the 5% range. And as you can see, Stand-up have been and still are our top shareholder, a beneficial shareholder at 6.6%, followed by the Government Employee Pension Fund at 5.5%. The usual suspects make up the balance. Just in terms of foreign ownership or international ownership, you'll see that over the last 5 years or so, Redefine's foreign shareholding has grown 10 times, from about 1.4% to 14.5%, with the bulk of the international holding coming from the States, sitting at 6.6%. Looking then at Redefine's investment story, you'll see that we make a compelling case to be invested in Redefine. Redefine, being the red line, as you can see, has comfortably tracked the SA listed property index and has beaten the all share index comfortably, as well as the bond index. And this is over the period to February 2013. If we had to draw this line on for the last couple of weeks, I think Redefine would definitely be in the upper range on a consistent basis. Looking at the total return for the 12 months to February, you'll see that the total return for Redefine, if you were to hold a unit from the 1st of March 2012 through to 28 February 2013, would have given you a total return of 33.3%, 75% of that 33.3% comes from capital growth. Your unit would have increased in value by 195 cents or 25%, and the balance would have come through in distributions. And those distributions would have been the second half distribution for last year, as well as the current declared distribution for this period, taking the growth to 8.4% and in total 33.3%. And that's it.
Okay, so I think you'll have seen from Andrew and David the enormous progress we've made and why we are very pleased with these results. So how do we look going forward? So firstly, I think that we've demonstrated over the last 4 years since the merger and the blip that we are able to forecast very accurately, and we've met every distribution since then, and there's no reason why we should not be able to do so going forward. We've got an excellent team, and our budgeting process is very robust and tested. So going forward, the outlook for the economy certainly remains subdued. There's no improvement for offices expected in the medium term. Looking towards the end of 2014, going into 2015, I do get a little concerned about retail sales. I think the events in China, the lower growth in China, could have some impact and on retail sales and pressure on consumers. But nevertheless, I think the sector will continue to perform well. Offices, B-grade offices in particular, as I've said previously, we need growth in GDP of 3.5% plus before we see anything meaningful happening in that sector. The restructuring of the core portfolio continues to bear fruit and will continue to do so. Strict focus on cost containment and sweating of the assets will be maintained and improved. Additional and new funding from debt capital markets will lower funding costs further. Our full-year distribution is expected to show growth at a similar rate to that of these results. No reason why they shouldn't. So we remain focused on improving property net income and acquiring revenue-enhancing property assets. And our full-year forecast remains in line with the previous guidance. So where do we see threats and where do we see the biggest potential problem coming through? I think that's largely political. It was explained to me very nicely the other day when I said, what happens if we have a downgrade in terms of South Africa's debt rating, the bond market, because we're seeing very, very strong inflows from offshore, both into bonds and into property. And it was put to me that we mustn't score an own goal. So in terms of labour unrest and various things that could happen in the next 3 or 4 months, if that's not properly contained and addressed, that could result in an own goal and could possibly lead to a downgrade, which of course would be disastrous, not only for the property sector, but for the economy. So quite buoyant and quite, I wouldn't say bullish, but confident about the year going forward. 7% or growth is good in these markets, particularly when you bear in mind that we've achieved this without any lumpy income, and also taking into account the fact that we are cleaning up our portfolio and selling properties at 9.5% and 10.5% and replacing it with lower yield. So pleasing results for now. More of the same going forward. Thank you very much for your attendance, and we're happy to take any questions.